All right, let's jump right in. We're talking about early 2026, and the Indian economy, well, it's in a really interesting and maybe a little bit of a tense spot. You've got the global economy kind of freaking out, but back home, the story is way more complicated. So, what's the deal? Are we looking at a massive boom, or is there some serious gloom on the horizon? Let's figure it out.
If you just walk around any big Indian city right now, it's like you're seeing two completely different Indias at the same time. On one side, you've got the boom, right? Malls are absolutely packed, the Nifty is hitting new highs, and so much of that is driven by people like you and me, the domestic SIP investors. But then there's the other side, the gloom. The Aam Aadmi is really feeling the squeeze from food prices that just won't come down, the IT job market is cooling off, and get this, middle-class savings are at their lowest point in a decade. So that really brings us to the big question, doesn't it? Everyone's calling India the bright spot in a pretty dark global economy. But are we actually recession-proof? I mean, really, is our own growth engine strong enough to power through, or are we just, the last domino that's about to fall? The stakes here are incredibly high.
Okay, to get to the bottom of this, we've got to listen in on the big debate happening on Dalal Street. It's the classic battle, the bulls versus the realists. This is the great Indian debate of 2026.
And this whole debate really comes down to two main camps. First, you've got the Viksit-Bharat optimists. Their whole argument is that India's growth is coming from within. They're pointing to the massive government spending on things like roads and ports, plus the whole China plus one thing that's bringing manufacturing back home. For them, any dip in the market is a golden opportunity to buy. But then, you have the late cycle realists. And they're waving a big red flag, saying, hey, we are not an island. They argue that if the US and Europe go into a recession, our huge IT export machine is going to take a major hit. We could end up importing a recession that smacks the urban middle class right where it hurts. And while all these experts are debating, there's this whole other conversation, or more like a shouting match, happening on social media. You've got these finfluencers screaming, market crash! And look, while it's good to be cautious, their biggest piece of advice is often to stop your SIPs. Let me be clear, that is a huge mistake. It's like seeing a 50% off sign at your favorite store and deciding not to go in. It just doesn't make sense, and we'll get into why.
Okay, so let's bring this down from the 30,000-foot view of Dalal Street and get real. How would a global recession actually feel for you and me here at home? Well, it all comes down to three very specific daisy triggers that would hit us directly in our households. Let's break them down.
Now, these three triggers, these are the things you really need to watch, way more than the daily Nifty number. First, an IT and startup winter 2.0, a deep freeze that could send shockwaves through our cities. Second, what I call the Thali inflation shock, basically the rising cost of your everyday meal. And third, this growing gap, this divide between rural and urban India, which could put a massive strain on the whole system. These are the signs that tell you how an economic storm is really hitting us on the ground. So let's talk about that IT winter. If the global demand for tech services just dries up, that hiring freeze we're already seeing in places like Bengaluru, Hyderabad, and Pune, it could get so much worse. And this isn't just about the tech jobs themselves. Think about it. When that well-paid software engineers stop spending money on a new apartment, a new car, or going out to restaurants, it creates this huge ripple effect that just grinds the entire local economy to a halt. And that second trigger, the Thali shock, could lead to a really nasty word you might hear, stagflation. It's this toxic economic cocktail, just the worst of both worlds. It's when economic growth just stalls out. So no raises, no new jobs, but at the same time, prices for your essentials, your dal, your vegetables, your petrol, they just keep climbing. So your salary is stuck in neutral, but it feels like your bills are doubling. And this connects directly to that third trigger, the rural-urban divide. Imagine a bad monsoon hits our agricultural output. Suddenly, rural incomes just plummet. When a massive part of our country stops buying things like tractors, motorcycles, and daily goods, it creates a demand shock that can drag the whole national economy down, no matter how shiny the malls and the cities look.
Okay, so I know that all sounds a little grim, but look, the whole point of this isn't to scare you, it's to get you ready. So let's pivot away from the problems and talk about solutions. It's time to build your own at-near bar, your self-reliant financial fortress. Here's your simple 3-step checklist. We're going to break this down into 3 simple core pillars. First, building your liquid suraksha, your safety net. Second, getting a real handle on your debt and all those EMIs. And third, and this is crucial, protecting your portfolio from your own emotions. So let's start with the absolute foundation, your safety net.
All right,
Rule number 1 is the rule of 6. You need, and this is a non-negotiable minimum, 6 months' worth of your essential living expenses stashed away. We're talking everything: your home loan EMI, your kids' school fees, groceries, insurance, the works. And here's the most important part. This money has to be liquid. That means it's sitting in a savings account or a liquid mutual fund where you can get it tomorrow. It's not tied up in real estate or physical gold.
Now, on top of that cash emergency fund, you should definitely think about gold. As Indians, it's in our DNA, right? We have this deep-rooted trust in Sona as a store of value when things get shaky. But in today's world, you don't need to be buying jewelry or biscuits. You've got modern options like digital gold or, even better, sovereign gold bonds. They give you that same safety, acting as a great hedge if the rupee starts to weaken during all this uncertainty.
Next up, let's talk about debt. I want you to do a little stress test for your own finances right now. Add up all your monthly EMIs, your home loan, car loan, any personal loans, credit card EMIs, everything. If that total number is more than 40% of your monthly take-home salary, you are officially in the danger zone. That is a massive red flag telling you that you need to start aggressively paying down your most expensive loans, like yesterday.
Now, this next point is something that honestly people tragically overlook all the time. So many of us rely only on the health insurance our company gives us. But think about it. In a recession, when layoffs are a very real possibility, that corporate insurance vanishes the second you lose your job. And that's exactly when a medical emergency could hit. A separate private health insurance policy for you and your family, it is not a luxury, it is absolutely non-negotiable.
And finally, let's talk about your investments. The rules here are actually pretty simple, but they take discipline. First, and I can't say this enough, do not stop your SIPs. A market downturn is a sale. It's when you get to buy more units for the exact same amount of money. It's a fantastic opportunity. Second, think about tilting your portfolio a little towards defensive sectors, things like pharma and FMCG, companies that sell things people need no matter what the economy is doing. And the biggest rule of all, do not panic sell based on some scary headline you see on TV or social media.
And you see, this brings us to the most powerful shift of all, a shift in your mindset. If you do these things, if you get your financial house in order, you completely change the game. You move from a position of fear to a position of strength, of opportunity. You won't just be trying to survive a downturn. You'll be the one who's ready and able to buy the dip when everyone else is selling.
And it's so important to remember, we've been through this before. Our parents, our grandparents, they navigated the 1991 crisis. They got through the 2008 global financial crash. And how did they do it? Through simple financial discipline and a whole lot of patience. Yeah, the challenges today might look a little different, but the fundamental principles for getting through them, they are exactly the same. So, what's the final takeaway from all of this? Look, the headlines are going to keep swinging from boom to gloom and back again. But at the end of the day, your financial well-being isn't going to be decided by the global economy. It's going to be decided by your own preparation. Because in finance, just like in life, fortune always favors the prepared.